All right, guys. So I've got 2:02 on my clock, so we're gonna go ahead and get going. Um, Anybody who joins later, they can just kind of join wherever they're at. But I want to respect your all's time and make sure we get in and out under the 2 hours that I've kind of set for this, and we leave a little time at the end for Q&A. So first off, thank you, welcome everybody. Thank you for coming and spending a little time with me this afternoon. Hopefully we can share some information with you guys, but for those of you who don't know me, and I think I know just about everybody on here, guys, my name is Alex Van Pelt. I am Kentucky's NFIP coordinator. I'm the state floodplain manager at the Division of Water. We're going to talk today about risk rating 2.0. What does this mean for us as floodplain managers here in Kentucky? Before we get going, a little bit of housekeeping. So, not everybody is as familiar with Microsoft Teams as they are maybe with Zoom or GoToMeeting or something like that. So I want to give you guys a little housekeeping with it. So whether you guys are joining me today with a mobile app, with a web browser, or with the Microsoft Teams desktop app, you all should see your controls there. Everybody's muted. I've done that intentionally just to make sure there's no distractions or other sounds or something like that, so that you guys can better understand me, and we can kind of stay focused on the topic. If you guys have questions, if you have concerns, if you want me to go back and cover something again, please use the chat box. Like I said, all three ways of joining the meeting today has the option where you can type questions and things like that into the chat. So if you do, please do that. Please don't use your raise the hand feature. Again, I have everybody muted, and it's too difficult for me to go in one by one and unmute folks until the end. So if you have something, please use the chat. Don't use raise the hand. I am recording this webinar, so everybody on here, I'm going to have a recording and hopefully get it posted to the Kentucky Flood Risk YouTube page here in the next week or so. So if you want to come back and rewatch something or recover something that you weren't necessarily clear on the first time, you're going to be able to do that. And before we get into it, I'm going to ask everybody that's on here with me today to go ahead and type your name and what community you are calling in from in the chat box, just to make sure everybody can hear me, make sure everybody can see that. So I'm going to give you all 30 seconds or so to go ahead and type, like I said, your name and community name into the chat box for me. Excellent, guys. Thank you for that. That just helps me kind of keep track of who's on the call with me today, where you all are calling in from, and things like that. So, give you a quick outline of what we're going to talk about in this presentation. So, I always try to start with a little bit of an NFIP background just to give everybody who may be newer kind of an even footing on what the NFIP is and what it's trying to do. We're going to talk a little bit about flood insurance today, or what FEMA is calling their legacy method for how they rated flood insurance policies previously. We're going to do a quick introduction of what Risk Rating 2.0 is, why FEMA has decided to do this, what this new rating method is hoping to accomplish. We're going to talk about what's not changing. So there's several parts of the floodplain management program that are not changing. So we're going to go through those. Just to kind of give everybody an understanding of not everything's going to be new, but then we are going to get into what is changing. So what are some of the new factors FEMA is considering? How is this going to affect policyholders and stakeholders and things like that? We're going to talk about how does these new changes with Risk Rating 2.0, how do they affect us as floodplain managers? We're going to talk about the transition timeline, and then at the end, we're going to talk about other resources. So if you want to look at something, more in depth, we can. All of this information is accurate as of today's presentation. I threw that little, box there at the bottom on there for a reason because things change. So everything that I'm talking about is accurate as of today. FEMA could come out tomorrow and announce they're going to delay it for 2 years. Things are subject to change, but everything I'm telling you is accurate as much as I can. NFIP background, most of you on here have been floodplain managers for a while now. So the NFIP was set up in 1968 by Congress through the National Flood Insurance Act. It set up the NFIP to provide flood insurance in communities that adopt and enforce floodplain ordinances. So essentially in communities that take action to protect themselves. NFIP is voluntary. We've got about 45 or so communities total in Kentucky that don't participate, but the vast majority do. It's over 350 communities are in the NFIP. The way the program works is your community agreed whenever you got into the program to adopt and enforce your all's local floodplain ordinance. Your ordinance should meet all federal, state, and local requirements as far as floodplain management and whatnot. When you enrolled, FEMA made federally backed flood insurance available to anybody in your community, regardless of if they are in a flood zone or not. So federally backed insurance is available for everyone. Big picture goal of the NFIP is to reduce future flood damages. So it does that by identifying, our risks. That's our floodplain maps. By setting development standards in those high risk zones. So you're in a mapped high risk zone. What are we going to make you do to protect yourself? No matter how high we set our standards, there is always a level of residual risk, and that's what insurance is there to cover, is to cover that risk that is always going to be there no matter what, because you're in a high risk zone. And then the last one is mitigate existing risks. So again, this was set up in 1968. There was a large amount of housing stock already existing in Kentucky. So taking an action to reduce the risk to existing structures. A little understanding of what flood insurance looks like in Kentucky. As of yesterday, Kentucky, we had 18,383 policies in force. So there are quite a few policies floating around Kentucky. Certain areas obviously have more than others. Louisville accounts for about a quarter of our population as a Commonwealth, and they account for a little over a quarter of the policies. Other areas like Pike County, Daviess County, certain ones like that have a high count. But, overall, we have a good bit of policies floating around. Those policies cover $3.38 billion in coverage. So there's quite a bit of structures and contents and things like that that are being covered with those policies. And again, I mentioned before, we have 359 participating communities. There's about 45 or so that don't participate, and of those, over half don't have any mapped floodplains. So, there's really no risk for them to manage. That's not to say that flood insurance wouldn't be beneficial to those folks. If you have communities in your county that don't participate, they should still join because flood insurance is not available for them right now. So I want to give you guys a little bit of background about how flood insurance worked up until about October. FEMA's terming this their legacy method because it's kind of going away. It's the previous one. So we're going to talk about how premiums were rated previously. And to start off, I want to show you guys this graph. So I took this from a FEMA presentation showing showing premiums collected under the NFIP, that's our blue bar on this graph, versus the payouts from the program. And you could see up until the early 2000s, the program was pretty much revenue neutral. The premiums brought in on certain years where you didn't have a lot of claims, covered other years where you might actually be paying out more than you're taking in. So the program was pretty much revenue neutral up until about Hurricane Katrina. And since Hurricane Katrina, we've had several major multi-billion-dollar disasters. Hurricane Harvey, Irma, Maria, Sandy, Michael. We've had several billion-dollar disasters where folks are making flood insurance claims that vastly exceed the amount of money that's coming into the program. So under the legacy method, up until recently, pretty much all policies were increasing to make the program revenue neutral. Again, the federal government's not out to make money with flood insurance. They're trying to have a self-funded program to where the premiums brought in cover the payouts. The way they were doing this, though, under the legacy method was everybody was just paying more. Average was about $8 per month increase for every policy in the NFIP. You can see at the bar graph at the bottom, 92% of policies were seeing $0 to $10 increase. 4% were seeing $10 to $20, and then another 4% were seeing over $20 a month increases in flood insurance premiums. And again, they kept raising until, again, the program was revenue neutral and until premiums covered the amount of claims and payouts. There were a couple known issues, though, with this legacy method. And if you've ever sat through previous flood insurance presentations with me, you're going to recognize a lot of these next two slides. So, number one, the legacy method is an outdated methodology. FEMA originally set this up back in the 1970s. And back then, that really was the best way to rate risk based on, some of the basic factors that FEMA used. It's 50 years later. There's a lot of things as far as data and standard practices within the insurance industry that this old method just does not cover. It doesn't factor in a lot of things that the private industry has learned. So, the old method rates were predominantly based on what flood zone are you in and what's the base flood elevation at your site. Another issue with it is the risk cliffs. So for anybody who's talked to policyholders where you are just inside or just outside the floodplain, there's a huge difference. So for this structure here in the red box, if it's built at BFE, at the base flood elevation, it's touching the flood zone. So they're in zone AE, they're paying about a little over $2,100 a year in flood insurance premiums. His neighbor, who might only be setting 1 inch higher, is just outside the 1% chance floodplain. He's in zone X. He's paying about $440 a year in flood insurance premiums. That's a huge drop just based on inside the line or outside the line. Again, known issue. Another risk cliff that was out there is anytime there's a map change. So getting flood insurance 30 days before new maps go into effect versus the day after, you're going to see a huge change. Because again, you're rated on what's your zone when you buy the policy. And the issue with these risk cliffs, just in versus just out is, flood risk doesn't magically stop or significantly lessen at the edge of the blue boundary. 25% of NFIP claims come from low risk or moderate risk zones. They come from outside the regulated floodplain. So anywhere it rains, it can flood. Other issues is, with the legacy method, it kind of encouraged people to locate in these high risk zones. How did it do that? Well, you can get insurance that's going to cover any losses that you have. So there was no negative financial penalty for living in these high risk zones. FEMA wanted to address that with this new methodology. They were using cost to repair, which again, at the time was kind of the best way to do it. So what this cost of repair calculation did was it skewed premiums that benefited higher value homes. $1 million home and a $100,000 home sitting side by side that both get an inch of water in it, one of those is going to have a larger payout, but they were paying the exact same rate in flood insurance. This led to some social inequality issues that again, FEMA felt like it needed to address. Cost of repair also doesn't really account for the change in housing stock. A house built today is almost twice the square footage of one built in the 1950s or 1970s. I forget the exact year they used as a comparison off the top of my head, but it doesn't account for changes in what the houses are looking like, how they're built, things like that. And then the legacy method also ignored historical flood events, so it didn't factor in prior claims. So think about a driver who, gets multiple speeding tickets, doesn't wear his seatbelt, and has hit several cars. If there's no financial penalty for him to pay higher insurance premiums, he has no reason to change the way he's driving. And that's essentially what the floodplain insurance was doing, is it was ignoring your historical events. Because of all these issues, because of all these factors, FEMA, over about the past 5 years, has reimagined how they look at how they rate flood insurance premiums. And what they've come up with is what they're calling Risk Rating 2.0, which is what we're here to talk about today. So to give you a quick insight into what Risk Rating 2.0 is, they're updating how they calculate risk and using that as their new pricing method. So essentially, they're recalibrating how they charge premiums to folks that have flood insurance. There are several benefits to this that are directly related to the NFIP program as a whole. Again, we're trying to get back to revenue neutral. So, again, government's not out to make money. They're just trying to get to the point where it's beneficial again. There's also going to be several benefits to individual property owners and to you all at the community level as well. So what is risk rating attempting to do? Well, they're trying to reflect more types of flood risk within the rates. Under the legacy method, pretty much all that the premiums are considering are 1% chance riverine flooding and 1% chance coastal flooding, and that was it. So this is going to look at more types of flood risk within the rating engines. It's trying to provide more logical rating variables and characteristics and things like that makes it easier for agents and for policyholders to understand what factors are benefiting them versus what factors are being held against them because they have higher risk. It's trying to expand mitigation because you're going to be able to take advantage of certain mitigation credits that provide a discount to your premium. So it's encouraging folks to take action to obtain those credits and to obtain those discounts. It's expanding CRS discounts within participating communities. We're going to talk more about this when we get to the CRS section. But FEMA has realized some of the ways CRS credits or benefits were applied previously weren't the easiest to understand for folks. Risk Rating 2.0 is simplifying and standardizing kind of the quoting process across the across the country. So multiple companies from multiple different states now are all going to be using the same rating process, the same rating engine, to make sure that they're all getting to the same rates. So you should be able to go from agent to agent to agent, as long as they click the same buttons and you have the same coverage and deductible limits, you should get the same quote every time, which is the way it should be. Whereas right now, folks with less experience with flood insurance sometimes will, give you an incorrect rate, and you don't realize it until you go to make a claim and there's an issue. Risk Rating 2.0 is also phasing out some older policy types. So preferred risk policies, grandfathered policies, submit for rates, and MPPP policies are all being phased out because we're changing what factors are being baked into the rating engine. So we're no longer just looking at flood zone, base flood elevation, construction, foundation type things like that. There's a lot more things. So some of these older policies that relied on those rate variables are going away. And then the last one, which is going to be huge for the individual insured, the individual policyholder, is going to be they're going to try and communicate better as far as what your full risk rate should be. So we talked earlier how everybody in the NFIP under the legacy method was seeing that year over year increase. There was no way off that escalator unless you got an elevation certificate and submitted it to your agent and allowed them to calculate your full risk rate. Risk rating 2.0 is going to put that full risk rate on your bill. So you're going to be able to directly see it and compare it to what you're paying now. So your insurance agent is going to be able to tell you how many more annual increases you can expect to see before you're at full risk. Okay. So pretty ambitious. Um, the main thing I want to kind of emphasize with this, though, risk rating 2.0 really is primarily focused on the flood insurance leg of the NFIP stool. Some of the other ones, the identification and mapping, floodplain management, things like that, those are going to be affected, but not to the extent of flood insurance portion of it. So we're going to cover quite a bit of the flood insurance stuff, and then we're going to get into how does this affect you all as floodplain managers later. Okay. Don't see any questions yet in the chat box. So if you guys have questions, if you think of something, please shoot them over there. I'll answer them kind of as we go. So before we start talking about what's new, let's talk about what's not changing first. There are going to be several aspects of what the program that you guys are familiar with that are not going to be changing. First one is going to be the mandatory purchase requirements. So people that live or buy property in the 1% chance flood zone, if they have a federally backed loan, they are still going to be required to buy flood insurance. That is not changing. Additionally, there's still going to be a 30-day waiting period on policies that people buy unless they're taking out a loan with it. The 30-day waiting period is waived if you are buying it in conjunction with a loan. So the requirement that folks have to buy insurance if they're in the 1%, if they're in the blue blob, is not going away. Other things that are changing is going to be like parts of our floodplain management program. So flood insurance rate maps, they are not going away. We're still going to use the floodplain maps to make floodplain management decisions. Similarly, the floodplain maps are going to be used by lenders when they make their mandatory purchase decisions. Okay, so the maps aren't changing. They may be tweaked, but they're not going away. They're still going to be used for decisions. Your community compliance requirements are all going to be staying in place. So still have to build your lowest floor at or above BFE. If your community has freeboard requirement, that's still going to stay the same. Floodway requirements as far as no rise and engineering analysis and things like that, that's not going away. So a lot of the standards that you guys are implementing day in, day out are not going to go away. Since the maps aren't changing or going away, LOMAs and LOMARs are still going to exist. So the letters of map change are still going to be out there. Folks can still request those. So if somebody is mapped in the floodplain and they don't think they should be, they can still request a LOMA and have FEMA administratively remove their property from the floodplain to get out of that mandatory purchase requirement. So that's still going to be there. Your flood risk is not going to change with a LOMA or LOMAR because it's looking at your building and where it sits and how it's built. But again, you can update the maps to reflect what's happening actually on the ground. Statutory caps. So we were talking earlier about the rate increases. Those are set by Congress, and Congress has essentially said through Biggert Waters Act and HFIA that premium rates can increase more than 18% per year. Now, your fees and things like that, as those change, that is on top of that 18%, but your premium itself cannot go up by more than 18% per year. Nationwide average is somewhere in the 12 to 15% range. Most of them don't want to go up too fast to, they don't want to shock people with the increases, but they have to go up at least 5% per year till you're paying full risk. There are still some policies out there that can see up to a 25% increase. This is things like second homes, vacation homes, businesses, etc. Those can see larger increases, but again, that 25% is capped by Congress. That's not going to change until Congress changes the law. Building content limits and building and content limits and ICC funding. So um, under the NFIP, there is a limit for how much structure coverage you can get and how much content coverage you can get. Those limits aren't changing. So it's still going to be $250,000 for residential structures and $100,000 for contents. Those limits remain in place. Again, set by Congress. Congress has to be the one to change them. ICC coverage is not changing. That's still going to be included on NFIP policies. Still going to be up to $30,000. Um, Qualification requirements to get that money is not changing. So you still have to have insurance, be in the special flood hazard area, and be declared substantially damaged. Um, the amount you're paying on your premium for ICC is changing. Instead of a $6 flat fee, it's going to be a percentage. But like I said, no change in the amount of coverage or how to get that ICC funding. Again, set by Congress. FEMA has no authority to. FEMA can't take that action unless Congress gives them that authority. And then the last one I want to talk about is some of the forms and policy assignments. So the forms that insurance agents use, they're not going away. They're just going to be tweaked or updated to reflect what Risk Rating 2.0 needs. So some of the things for like condo coverage or larger commercial developments, things like that, that's not going away. Policies can still be assigned to a new owner at sale. So flood insurance is one of those very few policies where you can transfer your policy to the new owner when you sell your home, whereas your buyer would go and get their own home insurance policy. Flood insurance can be assigned to the new buyer. So this allows people that have a discounted rate to transfer that rate to the new owner. So you can transfer that discount with structure. The buyer also now has 30 days to submit the paperwork to the lender for that assignment. Before you had to have that paperwork at closing. Now they're going to give you a 30-day grace period. If you don't, you go straight to paying full risk rate. But we'll talk about more of that later. So, okay. Robert asked, where can we look to see if there's a LOMA LOMAR applied for or approved by FEMA? So Robert, you can look up LOMAs and LOMARs through the MAP Service Center. So anything that's effective is going to be under the effective folder, kind of the same place where you would look at flood insurance studies or your flood insurance rate map panels. Additionally, anything that's been superseded by new maps or new studies or something like that are going to be in the historic folder there. FEMA also has a lookup window, and if we have enough time at the end, Bob, I'll show you this. But you can actually type in the letter of map change application number or the LOMA number and see kind of what its status is individually. So I can show that to you later, Robert. Otherwise, I can send the link to you directly. So that's what's not changing. So let's get into what is changing, and this is where we're going to spend a pretty good chunk of this 2 hours on. So I do have a break built in, guys, kind of in the middle of this. So don't despair thinking I'm going to keep you here for 2 hours straight without a breather. So we'll take a break here in the middle. But I kind of want to show you what the old rating methodology looks like versus what the new Risk Rating 2.0 looks like. So this is the information that FEMA and insurance agents pretty much used to determine what you should be paying for flood insurance premiums. So they considered things like FEMA sourced data. This would be your community's NFIP participation status. Are you on suspension or probation? Are you a CRS community? Things like that. That would factor into the rating. They essentially looked at 4 variables. So what's your floodplain zone on the map? Are you zone A, AE, X, shaded zone X, AO, AH, etc. There are also coastal zones. So those are your V zones. We don't have those in Kentucky. So pretty much everything was either A or AE or X. So high risk or low risk. They considered your base flood elevation. So in AE zones, they could get that off the map. In A zones, they would get that from the Kentucky Flood Hazard Portal. They considered foundation type. So how is your structure built? Think about the elevation certificate, all the different foundation or building types. And then they considered your structure elevation. So where's the elevation of your lowest floor? But that structure elevation was only considered if you were in the special flood hazard area, if you were in the 1% chance area, the blue blob. If you were outside that, your structure elevation didn't matter because the water wouldn't reach you during that 1% chance. They only considered the 1% annual chance flood frequency. So they only looked at the 100-year flood. Um, no lower intervals, no higher intervals, anything like that. It's just that 1% is all they looked at. And then they had some fees and surcharges and things like that on the back end that kind of rounded out how they got to what you should be paying for flood insurance. And this was, pretty much across the nation. The rating tables were set and they were applied from Oregon to Florida to Maine. Pretty much wherever you were at, you could look at that rating table, look at these couple factors, and get a quote. I've actually had several local floodplain managers call me and ask about risk rating 2.0. How are they going to do that? And the rating tables are going away. What the new methodology is going to look like is something more like this. So I'm going to quickly go through this, and then we're actually going to spend the next several slides talking about each of these data sources individually. So FEMA source data and then the fees and surcharges aren't changing. They're still going to be there. It's everything in the middle that's kind of changing. So beyond just the FEMA source data, FEMA is partnering with other federal government agencies to obtain and use some of their data. They're also buying commercially available third-party data that are out there in the insurance world to help better inform an individual structure's flood risk. They're going to consider the cost to rebuild a structure instead of just cost to repair. We talked about that earlier, that cost of repair can kind of skew the premiums towards high value structures. The rating variables themselves are changing. So now they're going to look at things like distance to flooding source, river class, what flood type are we talking about, what's your structure's ground elevation, your first floor height, how is it built, what foundation type, etc. We're going to talk about those more in depth here in a couple slides. They're going to be looking at a much broader range of flood frequencies, so not just the 100-year, but the 25, the 50, 100, 500, more. They're going to look at all of these different flood frequencies. And then again, like I said, the FEMA source data, the fees and surcharges, those aren't going away. Those are still going to be sticking around. So I'm going to kind of go through this, and we're going to talk about each one of these data sources that factors into the risk rating 2.0 individually. So I mentioned, FEMA source data, that's still going to be sticking around. What's your NFIP community participation status? Are you participating? Are you on suspension? Are you on probation? Are you not participating? All that's going to factor in. The floodplain maps, the flood insurance studies, those are still going to be factored in. And then your CRS participation status. So what's your CRS class if you're participating? That's going to be factored in. For the additional data sources, what they're doing is they're essentially baking some of these new risk considerations into the rating engine itself to help better quantify your individual structure's actual risk. So no more is it going to be, just saying, here's a generic rating table that covers risk everywhere. It's going to be looking at your structure individually. To do this, what FEMA's doing with these different data sources is they're actually baking them straight into the rating engine itself. Insurance agents and property owners are not going to have to do anything to access this data. So when the agent types in the homeowner's address, it's going to look at a lot of these factors and already have it pre-populated to where there's only a few individual questions about your building itself. So a lot of this, commercially available data is already baked in. This is a screen grab I took from a FEMA presentation a couple months ago, kind of showing what some of those data are. So again, FEMA source data, that's not really changing from what is out there now. What they are having access to now is like NOAA coastal data set. So better understanding what the coast looks like as far as topography and things like that. Army Corps of Engineers levee data set. So where are the accredited levees? Where are the Corps built levees that aren't accredited? Things like that. Those are going to be baked in to the quotes now. USGS is going to be one of the elevation data sources. So any USGS grabs LiDAR data wherever it's available. They try to keep the most accurate elevation out there for some of their topo maps and things like that. So they're using that. And then the third party data is going to look at things like the catastrophe models. So when you have a huge number of claims in a very small geographic region very quickly, that's something that private industry has been doing since the 80s or 90s, that the NFIP policies just haven't. Geolocation tool is going to be built in. So again, when they type in the address for the home, this geolocation tool should be able to figure out where the structure is and drop a lat long pin on top of it. First floor height tool, there's a way that FEMA is, I think it's Milliman or Cat Risk, I forget which company they've got this from, but it's going to estimate first floor height where it's going to be system generated versus having to go out and get an elevation certificate. We're going to talk more about the first floor height here in a couple slides, but that's another data set FEMA's buying. And then building replacement cost value tool, where that's estimated. That's coming from CoreLogic. So there's a lot of, again, different data sources that FEMA's trying to pull from to give themselves a better comprehensive look at what is the flood risk for this individual site. Okay. I don't see any questions in the chat, guys. Again, if you do have questions, please ask them in the chat box. I'm going to try and answer them as we go, and we'll have an open Q&A at the end as well. So moving on into the cost to rebuild. So building replacement cost is going to be a new rating element for all properties. Again, previously they looked at cost of repair, and again, that kind of skewed value towards those higher value homes. So the rating engine is going to be built in where it's automatically going to determine a replacement cost based on the information provided by the agent whenever they do the application. So it's going to consider, again, the loss difference between a high value home and a low value home. With that $250,000 coverage limit that we talked about earlier, a home that has 3,000 square feet versus one next door that only has 1,000 square feet, even though they both might have the same water level internally, there's going to be a higher payout for those higher value homes because there's more square footage that has to be repaired. That is going to be factored in now whenever you're talking about what is your premium, what is your risk, what should you be paying. So it's going to kind of make it more equitable across the board. I do want to emphasize, though, that replacement cost value is not the same thing as market value. Okay? So when we say replacement cost, we're saying what is the cost in your area to rebuild it in that site from scratch? We all know, and I think we all kind of intuitively understand that there's certain areas and certain markets where replacement cost is much higher just because of where it's at. Trying to replace a building in downtown Atlanta versus a rural area out in Iowa is very different. So replacement cost is going to be factored in on what does it cost to replace your building where it's at. Some of the key factors that are going into replacement cost value are going to be things like zip code. Again, where's your location? What year was the building originally built? What square footage are we talking about? How many floors and how many units? That how many units is going to be important whenever we're talking about, duplexes, triplexes, apartment buildings, things like that. And then I do want to kind of just give you guys an FYI. This is not super important for you guys as floodplain managers, but I want you to be aware that not all insurance policies are going to use replacement cost. Most are, but there are a couple different types, like condo buildings, non-residential buildings, or other residential buildings that are going to be required to submit some type of documentation with their application for flood insurance. So a condo building is going to have to provide some information about how the how the liabilities split up between the condo owner versus the condo association and things like that. So there are some policies that are going to have additional requirements, but pretty much across the board, single family, multifamily, things like that are going to be replacement cost value. Okay, again, guys, if you have questions, please ask them, because I would much rather to answer them as we're going through versus waiting till the end. Rodney, don't worry too much about what the other residential buildings are. Again, there's going to be very few of those, and it's not as relevant for us as floodplain managers. That's more for the insurance agents themselves, because again, there's going to be additional documentation. I've asked a couple times, can you give me a specific example of what an other residential would be? And I've not really gotten a great answer. So, Rodney, to answer your question, is I'm not really sure, but don't worry too much about it. It's not going to affect you all as floodplain managers. Okay, so now we're kind of getting into the rating variables. And again, this is really where FEMA, to me, is making the biggest change when it comes to flood insurance. So the standardized rating tables, again, that are used right now, they're going away. It's a legacy method. There are much better ways to calculate risk now. The other thing that's going to be going away when we're talking about rating variables are base flood elevations and flood insurance rate maps. Those are no longer going to be used when we're calculating premiums. So now what FEMA's doing is they're building this rating engine that's going to be available to all agents, that is going to have the algorithm for these different factors and how they're weighted built into it. So again, it's going to simplify the process while also at the same time considering many more variables. So it's going to be easier for the agents while also more accurately reflecting risk. Elevations are going to also be considered now for all policies. So again, under the legacy method, elevation was only considered if you were in the special flood hazard area. Now, even if you're in the low risk zone, elevation is still going to be considered because bigger floods do happen. There's also different flood types that might affect you if you're in a low risk zone, and we're going to talk about that here in a couple slides. So the first variable I want to talk about is going to be distance to flooding source and type of flooding. Okay. Under this new methodology, structures that are located closer to the source of flooding are going to be considered to having greater risk. Why is that? Well, if you live right on the river and my neighbor lives 100 yards back, typically there's going to be an elevation change because water's lazy. It takes the lowest, easiest route. So when you're closer to it, you're more likely to get flooded first. So your distance to flooding source is going to be a factor now. The other thing Risk Rating 2.0 is including now is, rather than just riverine flooding and coastal flooding, now they're going to be looking at things like inland flooding, storm surge, tsunamis, coastal erosion, flash floods, and Great Lake flooding. So there's a lot more different risk types that are out there that are going to be considered. A lot of these aren't necessarily going to apply to us in Kentucky. Storm surge, tsunami, coastal erosion, Great Lakes, things like that, those aren't necessarily going to apply. But the ones that absolutely are going to apply are going to be things like inland flooding or flash flooding and things like that weren't previously considered or weren't previously calculated into premiums. Okay. Other things that are going to be kind of considered with geographic variables are going to be like river class. Are we talking about your flooding source being the Mississippi or the Ohio River, or are we talking about a very small tributary in eastern Kentucky that only floods when it rains? Those different river classes are really going to affect what your flood risk is. Are you going to have flash flooding, or is it just going to be riverine and flash? Things like that. They're also going to consider things like drainage area. So how many acres drain to the river that flows right by your house? Again, if you have a very small drainage basin, you're in a holler in eastern Kentucky, you're going to have a pretty good rain directly over that basin for you to get flooded. Versus if you're, somebody up in Newport, you might get flooded from, rain happening up in Pittsburgh or something like that. So the drainage basin, and they're also going to consider things like urban versus rural risk. Urban areas typically have more impervious surface. Stormwater issues might crop up, things like that, that you may not have as much, if at all, in the rural areas. Ben asked, you have any idea why some lenders are asking for EC info prior to new building loans? This has happened for multiple properties. Um, Ben, I'm not really sure why they're asking for elevation certificates now. I'll look into that, Ben, and I'll get back to you directly because I've not heard of anything that's changed recently about why lenders would need an elevation certificate, but I will definitely circle back to you, Matt. Okay. Good questions so far, guys. So again, got questions, please ask. With these different geographic variables, they're again all going to be determined automatically in the rating engine itself using GIS data. So it's going to be using some of that federal data or some of the other third-party data, and it's all going to be based on the location that the agent enters whenever they're doing the flood insurance application. So again, a lot of this is going to be baked in, done automatically, so the agent doesn't have to worry about figuring out, am I looking at the right location or something like that. Now, we all understand that Google Maps and things like that aren't totally accurate. So I believe there is a correction process that the agent can take to make sure they're actually looking at the proper home, the proper structure. But a lot of the work is going to be done for them. Another variable that's going to be new is going to be local relative elevation. So essentially, it's going to be considered your structure's elevation relative to the flood source. Again, we kind of do this now. We kind of look at, what is your building's elevation in relation to the normal flow of a river or the base flood elevation or something like that. Now what they're going to do, though, is they're going to look at your building's elevation, and they're also going to compare it to what does the land around your building look like? Are you living in a bowl or are you on top of a mountain in eastern Kentucky? So they're going to look at the average elevation for an area of about 500 square meters around your building, which is, for those who are not metric in the metric system, you're talking about a third of a mile. They're going to look for an area about a third of a mile around your building and kind of compare your building's elevation to the average. If you are lower than that average elevation in your area, you're considered to have greater riverine flood risk because you live below a lot of the area around you. If you have a higher average elevation, so if you're kind of built up on a high spot, you're going to be considered to have lower risk. New variable is going to be the first floor height. So this is going to be the one that I'm expecting we're going to get the most questions about from you all as floodplain managers, because it's a little different now than what the legacy method has considered. So the first floor is going to, the first floor height is going to be the first floor of the structure where it's essentially going to be the first floor above grade. So it's going to kind of replace the elevation difference between lag and your first floor height. It's going to look at what's your first floor above grade. Again, legacy method didn't really consider elevations outside of the floodplain. So it's going to be a new way of looking at what is your first floor of your structure. Okay. There are two different ways that the rating engine or the agent can determine first floor height. The first one we talked about is going to be system generated, where that third-party data set is going to be used to kind of estimate what your first floor height is. And there's a lot of different ways you can do this, from LiDAR to Google Street View, things like that. But the other way is going to be the one that we're all familiar with, which is an elevation certificate. You're still going to be able to provide an elevation certificate to your agent, and they can use that for your first floor height as well. One of the changes, though, is FEMA has decided with this first floor height, whichever method is most favorable to the policyholder, that's the one that's going to be used when calculating your rate. So they're going to give folks kind of the benefit of the doubt. So if somebody brings an elevation certificate in to an agent and they look at it and say, the system generated first floor height is actually going to be better for you, that's the one the ratings engine is going to use. Again, they're kind of deferring to the property owner here. They don't want folks to feel like they're being punished for bringing an elevation certificate in or getting an elevation certificate. So still always, always, always encourage elevation certificates. For those of you on here that are CRS communities, you're still going to be collecting elevation certificates, but they're not going to be punished for giving that elevation certificate to their agent. So let's look at a couple examples of first floor heights. So again, first floor height is a little different than lowest floor elevation. So first floor height is going to be, the lowest area above ground level that is going to be used as your building. So in these examples, the one on the left, slab on grade, first floor height is going to be top of slab. Yeah, obviously. For the one on the right, it's going to be, again, where does your living space start? Everything below an elevated structure is not considered part of your first floor. With the system generated, what they're essentially going to do is they're going to use LiDAR or some other data source and compare ground elevation to what your estimated first floor height is. So they're going to compare adjacent grade to your first floor elevation. Where this gets confusing is going to be that basements, subgrade crawl spaces, things like that are no longer going to be considered your lowest floor. Okay. Now it's going to be your lowest floor above grade. So again, different. I expect many, many, many questions over the next 12 to 18 months about this. In fact, I'm planning on having maybe a whole talk with some of our FEMA Region 4 folks where they pop in and we can kind of dig into this more in depth to give you guys actual examples and why the thought process is behind this, okay? So if you want to ask me questions about this, I will answer them to the best of my ability, but I might have to defer to some of the FEMA staff. Okay. Kind of moving on, we're going to talk about building occupancy. So this is another rating variable that's going to be considered. So lots of different occupancy types, from single family home, residential mobile home, manufactured home, residential unit, 2 to 4 family building, the one Rodney asked about, other residential, residential condo buildings, and then non-residential, okay? Single family home and residential units used to be considered one occupancy type. Now they've been split out. So for single family homes, this is the ones you kind of expect where it's slab on grade or on a crawl space, but it also includes things now like townhomes or row homes and things like that. Whereas a residential unit would be an apartment above a laundromat or something like that, or above a business, where it's kind of more of a mixed use occupancy. So those are going to be different. Cindy, you asked what happens when a furnace is below grade. We're going to talk about that whenever we get to mitigation credits. So put that question back in your pocket for me, Cindy. We're going to get back to it. Another new rating variable is going to be number of floors. So again, no longer will your lowest floor be considered a basement, an enclosure, or a crawl space. We still want to encourage people to, have their crawl spaces or interior spaces at or above exterior grade. That's not going away. But what they're going to consider now is, if you have multiple floors, okay, well, the area above a certain height is less likely to have flood damages. So if I have a 2-floor building and, if it's going to take 10 extra feet of water for water to get up into my second floor, that's less likely to flood than the first floor. So they're going to kind of consider how many floors you have. Additionally, and Cindy, this is one that you've asked me about previously, where if you have an apartment building or a condo with multiple floors or something like that, they used to consider the lowest floor of the building on your policy. Now what they're going to do is they're going to look at the actual floor that your unit is based on. So in this example here on the left, If the person on the third floor comes to me, we're going to be able to write them now a policy for the third floor. First, second floor doesn't really matter to this guy. So he's going to be able to get a policy for just the third floor where he lives. So there's going to be a couple of questions on the insurance application. First one's going to be, is this a unit? And if it is, what floor is the unit on? Okay, that's the first question. And then the second question is going to be, how many total floors does the building have? So in this example, the guy's going to tell his insurance agent, I'm on the third floor, and there are 6 floors total. And that's going to be factored in now for his insurance premium rate. So, if the BFE is 10 feet, this guy on the third floor is going to be high and dry above that during the 1% chance flood or something like that. So he should be paying a lower premium than the folks who live on the first or second floor. Other rating variables we're going to talk about are going to be construction type. So FEMA has kind of simplified how they look at construction type. They've basically narrowed it down to 3 different types: frame, masonry, and other. Just like before, most everything is going to be frame or masonry. So I'm not going to read these definitions directly to you. You can read them yourself. The big thing, though, is if you have a building that is held up by wood or metal frame and has a brick veneer, it's still going to be considered a frame. That's the primary construction type. Whereas a commercial building that's using those 8 by 8 by 16-inch concrete blocks, that's going to be a masonry type. So almost everything is going to be frame or masonry, but they did throw the other out there because there are some very few select instances where neither frame or masonry is really used. And so again, that option is always there, but the agent is going to be the one selecting what type. These are also the same construction types that are used in the wider insurance industry as a whole. So again, FEMA's kind of bringing the NFIP up to industry standards. Another one that's kind of new is foundation types. So for those of you who are familiar with the elevation certificate, the elevation certificate has 11 different building diagrams on the back. FEMA has kind of consolidated those down for risk rating 2.0 down to 6 different foundation types. And we're going to talk about those now. So the first 3 I'm showing here, these are our non-elevated foundation types. So the first one's going to be slab on grade. It's basically exactly what it is. It's a slab of concrete built at grade. So for elevation certificates, building diagrams 1A, 1B, and 3, those are all going to be considered slab on grade for insurance purposes. Basement non-elevated, this is going to be building diagrams 2A, 2B, and number 4. These are going to be considered basement non-elevated foundations. Crawl spaces, anything less than 5 feet, including non-elevated below grade crawl spaces. So, areas below grade, they're going to be considered crawl spaces now, and that's diagram 8 and 9 on the elevation certificate. The other 3 foundation types, these are going to be our elevated ones. So the first one there on the left, elevated without enclosure on post, pile, or pier. This is building diagram number 6. This is the building type, or the foundation type, that is going to receive the best premium under risk rating 2.0. It's not flat on the ground. It's not subgrade. It's elevated with no enclosure underneath. This is the one that's going to get folks the best premium moving forward with this new rating method. Okay. The second one is going to be elevated with enclosure on post, piles, and piers. So this is where you have an area under 300 square feet that allows you access or storage, below BFE. These are the ones that are kind of more typical in coastal areas, Florida, things like that. And then the third one is going to be elevated with enclosure, but not on post, piles, and piers. So these are going to be solid foundation walls, whether they're poured concrete or again, 8 by 8 by 16 masonry blocks or something like that. This is where they're elevated with an enclosure, but they're not post, piles, and piers. This is the reason I say post, piles, and piers is going to have the best rate is because there's nothing underneath really that's going to be damaged. Whereas if you don't maintain your vents, you could see hydrostatic pressure on your elevated with enclosure to where you see cracks in your foundation and things like that. Your flood insurance would have to pay out on that. So you're going to pay a little more for that foundation type. Okay. I don't see any questions, so we're going to keep rolling right along. One of the really big new variables is going to be prior claims. So, prior claims were not used in the legacy method. Additionally, when these policies transfer over to risk rating 2.0, prior claims are not going to be included in the initial rate calculation. What's going to happen is after they transition to risk rating 2.0, once they make their first claim under this new methodology, that's going to trigger a 20-year rolling period. Okay. We're going to go through a couple examples here in a second, but they're not going to consider prior claims until you make your first claim under this new rating method. Okay. Severe repetitive loss properties, they have a surcharge attached to their flood insurance. Same kind of things happening. Okay. That surcharge for severe repetitive loss is going to stay in place again until they make their first claim under the risk rating 2.0 methodology. Okay. Rodney had a question about it in my previous slide, so I'm going to go back. Which one was an elevated slab without openings? So Rodney, if I remember correctly, that's going to be the still slab on grade type. I'm not 100% sure, Rodney, so I'm going to have to get back to you on that. I know what you're asking, where you backfill a slab where it's elevated a foot or 2 foot or something like that, and I don't know. I don't know. This is new to me too, so I'm still trying to figure out and get you guys the answers you need. So if I'm not able to answer your question, guys, I will follow up with an FAQ later on. One of the things I want you to remember, though, so we're back to talking about prior claims. Remember, flood insurance claims follow the property. They do not follow the policy holder. Why is that important? So if somebody buys a property in the floodplain, those claims go with the building. Because again, risk rating 2.0 is looking at the building's risk. So when that new policyholder makes claims, those previous ones, even before they bought the property, are going to be considered if they're in that 20-year window. Okay. There are a couple types of claims that are excluded that are not counted against you. Not super important for us as floodplain managers, but I want you to be aware. ICC claims, so for increased cost of compliance, or claims without payment, so where they made a claim and they either didn't meet their deductible or their claim was denied, those are not held against you. Again, excluded losses is really insurance jargon for the agent, but I want you to be aware that there are a couple different types of claims that aren't necessarily considered. So here's an example of that 20-year rolling period. So right now we are kind of here. Bear with me while I get my laser. So we're right here now in this 2022 where risk rating 2.0 is just about to go into effect. In 2 years, 2024, after this policy is renewed, they make a flood insurance claim. Okay. Once that claim is made, it triggers the 20-year rolling period. So now going forward, any claims made in this 20-year period are now going to be considered when they calculate your premium. Okay. With this, the first claim is excluded. So they give you one free pass essentially in this 20-year period. So there's 3 claims. In this example, only 2 would be considered against you whenever your premium is calculated. Again, rolling 20-year period. So this 20 years follows you. So first claim was made in 07. In 2027, that should start falling off. So you should only have 2 claims, only one of which would be held against you now in that 20-year period. Does that make sense? If anybody has questions about that, if you want me to explain it again, I can. So just let me know. Another example is going to be the second one here, which is a severe repetitive loss property. So again, same way, claims prior to 2022, before it transitions over, are not considered. So severe repetitive loss, that's 4 or more claims in a 10-year period of $5,000 or more. So we've got 05, 08, 11, and 2014. Once it became severe repetitive loss, that SRL surcharge went into effect, and it stays on there going forward. That surcharge doesn't change under risk rating 2.0, again, until that first claim under risk rating 2.0 is made. Once that's done, that surcharge goes away, and now it's considering prior claims. So it's considering 4 claims. Again, though, first claim, 2005, in 2025, that should be beyond the 20-year period. That first claim will fall off, and they'll only be considering 3. So that rolling period follows you, for every year that you renew. It's 20 years from the day you renew. Okay? Any questions with that? I don't see anything, but I want to make sure I'm giving you guys the option to ask questions in the chat. So if you have one, please ask me. That's kind of it for the rating variables. Now we're going to talk about the flood frequencies. So again, the legacy method pretty much only considered the 1% chance flood event. So 1% chance riverine flooding, 1% chance coastal flooding. Okay. The new rating engine is going to have the ability to factor in more broader range of flood frequencies, anywhere from the 10-year up to the 10,000-year flood frequency. Give you guys a great example. Hurricane Harvey was either an 800 or 1,000-year event there in Houston. Policyholders are now going to have that low risk level factored in to their flood risk. Another thing that's going to be kind of factored in with the broader range of flood frequencies is, again, they're also going to be considering levees. So accredited levees are going to get the best possible rating because it's accredited, it's held to a much higher standard, it's going through inspections, it's having ongoing maintenance done to it, things like that. But they're also going to consider unaccredited levees. Now, the benefits are not going to be nearly what the accreditation one is, but it is going to consider some level of flood protection. It may not be, the 100-year, but it will be some level of protection. Great example of that, guys. I'm going to use my own parents as this. So they live in Southern Illinois behind a core belt levee that is not accredited. They don't have the $8 million to get it to the BFE +3 freeboard requirement that the Corps needs to get that positive accreditation. My parents are still going to see some level of protection in their flood insurance premiums, but it's not going to be as much as it would if the levee were accredited, okay? The rating engine is also going to include other types of flooding. So catastrophe modeling. Again, when you have a huge number of claims in a very small geographic area over a very short time, it's going to consider that level of flood risk in the premiums where that is most likely to happen. It's also, again, going to look at urban flooding. So development, drainage issues, things like that can cause additional flooding because you have that additional impervious surface. Stormwater systems require ongoing maintenance to make sure they're functioning properly, where you're cleaning out culverts and manning your storm sewers and things like that. So that type of flooding is also going to be considered now. So somebody living in Jefferson County, Louisville metro area, they're going to have a much higher level of urban flooding than somebody living in Horse Cave, Kentucky, where there's not the amount of development that has happened. Okay, so again, those metro areas have higher risk, therefore the premiums are going to reflect that. The last one we're going to talk about is the fees and surcharges. And again, these really aren't changing from the legacy method to risk rating 2.0. So there's not going to be a huge change with these. So all the existing fees, all the existing surcharges are going to kind of stay in place under this new method. So the reserve fund, HFIA surcharge, severe repetitive loss fee, federal policy fee, probation surcharge. So if your community gets put on probation, that surcharge is going to stay in place. So the fees are really not changing from the legacy method to risk rating 2.0. But that is going to be, again, another factor in on your community's or I should say your individual building's flood risk. Okay. Um, the last thing I want to show you before we get into our break, guys, FEMA has put together a really simple, straightforward, 3 or 4 minute long YouTube video where you can go and watch and kind of see how the rating engine is going to work for the insurance agents themselves. So this is really great to show to property owners, to show to folks in your community who might be getting questions when it comes to how is risk rating 2.0 going to work. Unfortunately, FEMA has this video unlisted, so I cannot show it within the presentation today. It's unfortunate, but you can copy that tiny URL, which I'll post in the chat box here in just a minute, so that you can kind of copy it and go watch it at your leisure. Like I said, it's just a couple minutes long. I'm also going to be posting this video in March, closer to when Risk Rating 2.0 rolls out nationwide, to full effect. Because again, you're going to be hearing a lot from me over the next coming months because we're getting close to that full rollout date. I've been talking for over an hour now, so we're going to take about a 5-minute break, guys. So I've got 5:12, almost 5:13. So we're going to come back here in about 5 minutes. So be back at 3:18, and we'll get going. For those of you who hopped on late, please type your name and the community you represent into the chat box just to help me kind of track who's here and who's participating. So if you haven't already done that, please put your name and your community name in the chat box now, and I'll share that link whenever we come back. Thanks, guys. All right, guys, kind of rolling into the end of the break here. So thank you guys for posting your names in the chat box. I did post the link to that video we were just talking about a minute ago about the example rating process, kind of giving folks an idea of what it's going to look like. I posted the link to that in the chat box. If you can't see the chat box or something like that, email me directly. I can get it to you later. But we've got about just over 20 slides left and about 40 minutes to go. So we should have a little bit of time there at the end for Q&A. So once we get to that point, guys, I'm going to attempt to take everybody off mute. But again, we'll get to that when we get there. So kind of moving right along. There's some other factors with flood insurance and flood insurance rating that are going to be changing, and we're going to talk about that before we get into what does this mean for us as floodplain managers. So statutory discounts, those really aren't changing as a whole. So the discounts we're talking about are going to be pre-firm discounts, newly mapped discounts, and then a couple other ones. But primarily, FEMA is getting away from subsidizing these policies through these discounts. What they're going to do under Risk Rating 2.0 is they're going to start where they're at, and they're going to start transitioning towards their full risk rates over time. So what this is going to mean for the policyholders is for the folks who are not necessarily seeing changes in their premiums now because they're pre-firm or something like that, they're going to start transitioning over time. The policyholder in general loses this discount if they allow their policy to lapse. So we talked earlier about how the policy goes with the property when it's sold. If the existing policyholder cancels their flood insurance after the sale, the buyer does not get that discounted rate. They have to assign it, through closing to that new owner. If the existing policyholder either cancels it, if they allow their policy to lapse, meaning they wait more than 30 days from when it renewed to pay their premiums or something like that, that's considered a lapse. When you come back in, you do not get that discounted rate again. You go straight to full risk. You're going to pay what your structure's risk level is. Other changing factors are going to be like the CRS discount. So unlike the legacy method, CRS discounts are now going to be uniformly applied in qualifying communities, regardless of if the structure's in the 1% chance floodplain or not. Okay. Give you a great example. We're going to use Louisville. Louisville is a CRS Class 3. They get a 35% discount for structures in the floodplain. Structures out of the floodplain, though, even though they're a Class 3, only gets a 10% discount. Okay? So Class 8 policies, they would get 10% discount in the floodplain, 5% outside. Now, under risk rating 2.0, that discount percentage is going to be uniform regardless of where that policy's at in relation to the floodplain. Okay? So what this is going to be, it's going to be a flat percentage with no difference of in or out. Again, that whole mentality of just in versus just out is going away. Your flood risk doesn't radically change depending on what side of that line you're on. So the risk is going to be how is your structure built, and you're going to get a percentage now for CRS participation. This is an example FEMA showed us a couple months back. The one that I really want to draw your attention to is structure number 2. Again, right now, CRS Class 6, Class 4, 30% discount. For those outside the special flood hazard area, they are only getting a 10%. Under risk rating 2.0, they're going to get the full 30% now. For preferred risk policies, again, since those are kind of going away, they're going to be transitioned up to full risk. Once those PRP policies are paying full risk rate, they're going to get the full 30% under risk rating 2.0. The other one's going to be for non-compliant buildings. So if you have a non-compliant building, whether they're in the floodplain or out, doesn't matter. If they're non-compliant, it will not get a discount. Okay, you're not going to build in violation of state or local requirements and then turn around and get a discount because the community you're in goes above and beyond. It doesn't work that way. They still got to build in compliance to get the discount. But once they do, they'll get the full discount that your community is entitled to based on your CRS class. Cindy, you were asking earlier about machinery and equipment, and this is where we're going to kind of circle back to your question. So machinery and equipment, the lost costs on those are going to be baked into the premium already. Where machinery is going to be important or become more of a factor now is you're going to get a mitigation credit for how you develop and where you locate your machinery and equipment. Okay. So Cindy, you asked what happens if you have a furnace in a basement below grade. That furnace is already going to be baked into the rate. They're going to get a credit now for relocating that furnace. So the way it's going to work is policyholders that elevate their machinery and equipment to above their first floor are going to see this credit. The agent, completing the application, they're going to be the ones responsible for self-certifying that it is located in the correct position. This is a little confusing, so bear with me. The machinery has to be elevated to at least the elevation of the floor above the building's first floor. Clear as mud, right? So to give you guys a couple examples, if you're talking about a slab on grade building with a single floor, the machinery and equipment has to be elevated up into the attic area. If we're still talking that same slab on grade building, but it has 2 or more floors, it has to be elevated to at least the second floor. Buildings with basements or crawl spaces, they have to be elevated above that basement or above that crawl space. Again, what they're kind of assuming is that your building was built into compliance, therefore your lowest floor is going to be above that BFE. And then others, again, same way, it has to be elevated to above whatever the lowest floor is. Here's the example that FEMA showed us for where the machinery and equipment needs to be elevated. So again, slab on grade has to be up in the attic. Pretty much for the rest of these, it has to be, your first floor, your first living space. So it can't be down in the crawl space. It can't be in a basement. It can't be in the enclosure below your lowest floor. It can't be, in your enclosure on post piles or piers, or it can't be in your enclosure on foundation walls or something like that. It has to be above whatever your lowest floor is. Cindy, you asked, how do we estimate a discount to encourage the move? Um, Unfortunately, we can't estimate the discount anymore. FEMA right now, with the way they're rolling out risk rating 2.0, they're doing it in such a way where they are encouraging folks to talk to their agents to understand what relocating their machinery would get them as far as a discount. Same way with some of the other mitigation credits we're talking about. I don't even have access at the state level. Right now, FEMA Region 4 staff don't have access to the rating engine. I'm really, really hoping they give me access at some point because I've made this point every time I've talked to FEMA staff, whether it be regional or headquarters staff, saying you're taking one of my tools out of my toolbox and telling me to do the same job. Um, so right now, Cindy, we can't estimate that, but encourage whoever you're talking to go talk to their agent, um, to make sure that they understand that if they elevated their heater, if they elevate their hot water heater, if they elevate their AC unit or something like that, here's the kind of discount or change in your premium that you should see. And they're going to be able to weigh that cost of the relocation versus paying the higher premiums over 20 or 30 years. Other mitigation credit, that's going to be out there are going to be flood vents. So the rating engine is going to apply the discount to any policy in any flood zone that has the correct number of openings. So, the minimum flood vent requirements still apply. You still have to have minimum two. They have to be on at least two walls, within a foot of grade, and you have to have 1 square inch of vent space for enclosed space. All of that still applies just like it does right now. But where this is going to start benefiting folks is that are ones out in the X zones that may only see flash flooding or stormwater flooding or something like that. If they properly vent their structure, and vents are relatively inexpensive, they're going to see that mitigation credit on their premium. Again, agent is going to be the one responsible for ensuring that these are properly listed. The reason FEMA is set it up to where the agent is the one responsible is because the agents are licensed. They have to do continuing education credits. They have to self-certify these discounts. If it's found that agents are lying on the forms, they're putting their professional certification at risk. So by making the agents be the one ultimately responsible for this, FEMA is putting somebody in charge who has some level of skin in the game. There's some way to hold these agents accountable if they're just flat lying on the forms. So that's why the agents are the ones kind of being responsible for checking all these boxes. Another mitigation credit is going to be the flood proofing. So again, you're not going to just automatically see a discount for flood proofing until you prove that your building is built in such a way that it is flood proof. So as you all know, flood proofing is the alternative to elevating your building to above BFE. Instead, you can flood proof your building to BFE +1, or BFE +1 plus your community's freeboard requirement. The insurer, though, is going to be the one responsible for submitting the documentation showing that the building was actually built to floodproofing requirements. That documentation is going to be submitted directly to FEMA to determine that discount. So FEMA is going to be the one saying, yep, we agree this building is built so that it'll be flood proofed. Or FEMA is going to say, nope, you're not eligible for this discount, and here's why. So again, there's going to be some level of documentation. So if folks want this discount, it's more than just building it the right way. Now you've got to submit that information to FEMA before that discount becomes available. Other changes. So we talked earlier about some of the policy changes. Oh, sorry. Rodney just asked a question. If the insurance agents are responsible for verifying vents, are floodplain managers also responsible? Not during the insurance process, Rodney. We're still going to be responsible whenever we're talking about building permits, development permits, new construction, substantial improvements, substantial damage, things like that. So during the permitting process, floodplain managers are still going to be responsible for ensuring that the proper number of vents are put on there. But the agent is going to be the one, if somebody just outright owns their home, they may not have flood insurance. The agent's going to be the one when they come to buy insurance where there's going to be another level of checking to make sure that it's properly vented. And if it is, you're going to get that credit. So yes, Rodney, short answer, yes, you're still going to be responsible as the floodplain manager through your permitting process and through your enforcement process of making sure the vents are there. Okay, so policy changes. Again, risk rating 2.0, we have a brand new set of factors and variables and things like that that we're considering. So grandfathering policies is really one of the ones that people worried about when FEMA first started talking about this. And what FEMA quickly realized is there are not nearly as many grandfathered policies out there as they believed. I think there's only like 190,000 grandfathered policies nationwide. And that's out of several million policies. So there's not as many grandfathered as you'd expect. Because the variables of BFE and flood zone are no longer going to be considered with rating, grandfathering is going to be going away. So again, grandfathered policies are going to start where they're at, whatever they're paying, and they're going to be put on the glide path up to full risk rate. That statutory cap, that 18% cap, if it's your primary residence, or 25% if it's a secondary residence, that's going to stay in place, but you're going to be put on the glide path going up to full risk rate. No longer are we going to be subsidizing grandfathered policies. The other thing that's going to be happening is, again, I mentioned this before, but there are going to be several policy types that are going to be retired. These are going to be our preferred risk policies. So PRPs are only available in X zones. We're not considering flood zone anymore, so PRPs are going away. Submit for rates. These are the ones where they're either severe repetitive loss, they are negatively rated or something like that. These are the ones that would be submitted directly to FEMA for rating. Those are going away because, again, all of that is going to be built into the rating engine now. You no longer need FEMA to do that. Therefore, submit to rates are going away. And then the MPPP, the Portfolio Protection Program, there's only like 100 of those nationwide. So FEMA is basically just doing away with that. They're transitioning everything over to the new policy type where you're going to be paying full risk. Okay. And then, one other thing I wanted to say about grandfathering before we move on. So again, with grandfathered policies, when the transition happens, what's going to happen is there's going to be two different calculations done for the grandfathered policy. Whichever method is cheaper, that's where that policy is going to start on the glide path. So if risk rating 2.0 is cheaper for that grandfathered policy, they're going to be re-rated under that risk rating 2.0. If the existing method, the legacy method, is cheaper, they're going to use that whenever the transition happens. But regardless of where you start, that glide path is going to take into effect. And again, eventually these grandfathered policies are going to be paying full risk. Okay? Okay. That's all I had, guys, for the variables. And I know we spent, like I said, about an hour talking about those. So we're going to transition now into what does this mean for you guys as floodplain managers? And you've already asked several really good questions. But now we're going to talk more directly about what is this going to mean for your day-to-day as far as permitting and things like that. So I want to call back, again, flood insurance rate maps, those are not changing. The acronym has to change. The acronym has to change because the maps are no longer going to be used for rating, but the firm themselves, the panels, the digital flood maps, those are still going to be used. They're still going to be updated. They're still going to be used for management decisions, the mandatory purchase, stuff like that. Permits are also still going to be required anytime you're in the 1% chance area. So our flood ordinances, we're still going to be using the maps to enforce our ordinances. We're still going to be using the development standards. All of our regulatory standards all stay the same as they are now. Okay. Most of what risk rating 2.0 is changing is how does risk calculated for your flood insurance. So lowest floor elevation that's required by your ordinance, that stays the same. Your freeboard requirement stays. Floodway requirements, so no rise, engineering analysis, all that. You're still going to be required to elevate your machinery, utilities, and ductwork to at or above BFE. But here's where the change is going to happen for us. So anytime we're talking about new structures or substantially improved structures specifically, um, we need to make sure we're communicating with these people or with these developers to let them know that they need to keep risk rating 2.0 in mind for how they are designing and building these structures. Okay. So what we need to do as floodplain managers is we need to recommend setting the building back farther from the flooding source. That's one of the factors that are now considered when we're talking about your flood insurance premium. So giving the river room to flood and leave the floodplain as unaffected as we can, you know, they're going to see a difference based on where they locate that building in their premiums. Recommending building on naturally higher ground is going to be beneficial because, again, they're going to be looking at your local relative elevation. So, are you above the average elevation in your area, or are you below? The higher you build, the higher ground you build on, the better. That's going to address one of those factors that's going to end up with a cheaper premium. Recommending constructing with post piles and piers versus some of the other different foundation types. Let them know, hey, how you develop, what foundation you choose to use is going to affect what you're paying for your flood risk later on. And then again, Cindy, you were asking about how do we encourage people to elevate utilities during new construction, or when you're repairing substantially damaged construction, or somebody's doing something that's substantially improved, or if they're even if it's not substantial, if they're doing an improvement project or a rehab project. Hey, guys, while you're doing the work, put your utilities up high so when you pay flood insurance premiums, or whenever you sell the house and that person has to get flood insurance premiums, it's going to be less expensive on them. So keeping these variables and factors in mind when we issue permits or make recommendations are going to be very beneficial. Outside of new or improved structures, talking to people about installing flood vents, whether they're in the floodplain or not, letting them know, hey, vents are inexpensive. You can get engineered flood vents from Lowe's or Home Depot or whatever for $50 to $100 per vent or something like that. So for a couple $1,000s, you can put vents on your home, and the insurance premium savings that you're going to see over a couple years should, pay you back for that. And then you're just saving money going forward. So making building and development and construction standards, recommendations to folks moving forward is going to be very important in your all's role as floodplain managers. For lenders, where this is going to be important is, again, they're still going to be required by law to do mandatory purchase. So they're still going to be using the floodplain maps. That's not changing. If you're in the 1%, they're still required by law to make you carry insurance. They can still require flood insurance at any time. And in fact, one of the things FEMA had in mind when they rolled out Risk Rating 2.0 was making it in such a way that, lenders can say, oh, there is still some residual flood risk. We want you to carry insurance, because now they can work with an agent and kind of get that information during closing. So Ben, you were asking earlier, maybe this is why lenders are all of a sudden asking for elevation certificates to make sure they're getting the right rates, or using it to determine flood risk for their mandatory purchase. That could be the answer. I don't know, but it's not outside of the realm of possibility. And again, the big change for folks is going to be for the agents. So now they're going to use the rating engine with a lot of these information and data and stuff already baked into the engine itself. So when they quote premiums, a lot of the work is already going to be done for them. And again, Cindy, you asked how do we estimate or encourage people to take mitigation action? How do we encourage them to take mitigation actions? The answer right now is sending them to an agent. Again, the reason that FEMA is doing this is because all of these premiums are property and structure based. So, no longer can we say, oh, if you elevate your home 2 feet, you're going to see this much and your premiums go down. Because, that's not really taking into account what foundation type you have, or how far your flooding source is, or some of these other factors. So right now, we have to send folks to agents um, to have the agent quote the premiums. Um, but once this risk rating 2.0 rolls out, property owners are going to be able to talk to them about how different mitigation actions could affect them, how different variables affect their premiums, things like that. Elevation certificates are, again, always preferable. That's not changing. CRS communities out there, you're still going to be collecting elevation certificates because it really is still the best way to understand your structure's flood risk. What the ratings engine is going to do though is it's going to estimate a lot of this so that it's a lot more accurate without an elevation certificate. But elevation certificate is still considered best available data for a structure. And we still need to let folks know that improperly located or improperly constructed homes are going to negatively affect the policyholders once they start paying insurance premiums. So it's very important that folks understand that how you build is still going to affect what you pay later on. And then for the CRS, again, we talked about it earlier, but there, communities that currently participate, as policies are renewed, you're going to see more savings under CRS than you are currently. Again, the percent discount you got is very dependent on what flood zone you're in. No longer will that be applicable. Now, whatever your CRS class is, that's the level of savings you can expect across all policies in your community. For those that aren't in CRS, this is kind of an added benefit now where you're going to see the amount of savings that you're estimating or that I'm estimating whenever I tell you if you join CRS, you could see X dollars of savings per year because that is going to be applied again uniformly now, regardless of flood zone. It's also still going to continue to recognize communities for going above and beyond. That's not changing with CRS. So for those of you who are in a lot of your requirements for CRS and a lot of your activities and all that, that's going to stay the same. Again, the big benefit with CRS under risk rating 2.0 now is that it's going to be uniformly applied regardless of zone. And again, non-compliant structures are not going to receive the discount. So Cindy, I know you've got a couple folks who like to just go their own way and do their own thing up in Campbell County. We're still going to use our ordinance to hold them accountable. We're still going to issue stop work orders. We're still going to issue NOVs. We're still going to, take them to court. 1316, denial of flood insurance is still a possibility. But if they bring it into compliance, now you can tell them they're going to see whatever your CRS class for that community is, and that you're going to see that. So it's going to make it a lot easier for you guys as floodplain managers and as a lot easier as policyholders. The other big effect, again, the whole point of risk rating 2.0 is FEMA wants to make this more equitable. So it's going to be looking at individual structure risk versus just setting rating tables for the nation. So, there are going to be different variables that will positively or negatively affect every structure out there. I showed this bar graph before where 92% of folks are going to see a 0 to 10 increase, and 100% of folks are going to see some increase. Under risk rating 2.0, this is what FEMA is estimating is going to happen to to policyholders' premiums in Kentucky specifically. So starting April 1st, 29% of policies when they come up for renewal are going to see a decrease. There's going to be over 1,000 policies in Kentucky that are going to see $100 per month decrease compared to what they're paying now. That is enormous savings for those people that have been overpaying for all these years. So it's automatically going to start making it more fair. 54% are going to see essentially no change from what they're seeing now. They're still going to see that $0 to $10 increase. About $8 a month is the national average. So what is that? 83% of policies are either going to see no change or a decrease. That right there is huge. And then you're going to have the ones on the upper end where, they've had high risk and their premiums have kind of been subsidized by some of these lower risk, lower value homes. No longer. Now you're going to see about 11% of policies when they renew getting a $10 to $20 increase per month. And you're going to see 6% that are going to see over $20 a month increase. So when you start getting calls of my flood insurance went up a lot, you're going to be able to tell them, well, there are new factors at play. How close are you to the flooding source? What foundation type do you have? What's your first floor elevation? You can do these other things for your mitigation credits there. They're going to go down. So, looking at this bottom bar graph, this to me tells me it is going to be much more equitable. It's going to be much fairer for the people with high and low premiums. Cindy says they are already starting to see some of those reductions in older communities. And yeah, Cindy, you just jumped ahead of me by about 2 slides with that. So we're going to talk now about the timeline of when this is rolling out. So the timeline is actually already started. As of October 1st of last year, 2021, new policies, new single-family, multi-unit, or new commercial properties were put on this risk rating 2.0. Starting April 1st, as again, policies come up for renewal, whether their premiums increase, decrease, or no change, doesn't matter. They're going to transition over to this new rating method starting April 1st, and that's for all policies out there. So we're coming up, we are about 6 weeks out from this rolling out for all policies as they renew. FEMA, I have to give them credit, was pretty smart with how they did this implementation. They gave themselves about an 18-month window where these policies are going to be transitioning over time. So rather than saying as of April 1st, every policy gets re-rated and you either get a discount or you pay the new, now they're going to say, as you come up for renewal, that's when the change is going to happen. So again, from October of last year through March 31st of this year, existing policyholders, as they came up for renewal, they were given the option to renew under this new pricing method. And if they chose to do that, they could. So those with a decrease or those who saw similar increases under the new method, they were given the option. My parents, they renewed their policy in September. Otherwise, they were eligible for a decrease. So it was really unfortunate they had to pay that higher premium for just one more year. But in September, my parents are going to start seeing that decrease. Starting April 1st, though, decreases will go into effect immediately. So if you get a $20 a month decrease, that's going to go into effect immediately. Increases, again, have that statutory cap where they can only raise so much over time. So, those are going to see steady increases over time until they get to full risk. PRP and newly mapped are, again, transitioning to the new methodology because of the different rating variables. But, again, when folks renew, they can look at their different coverage amounts. They can look at their deductibles because those are ways that policyholders can, change what they pay without physically changing their structure. So, again, $250,000 structure coverage limit, you can decide to only have $200 or $150 or $100,000 of coverage or something like that. Or, you can say, I want a $10,000 deductible instead of a $5,000, and that's going to change your premiums. With the implementation, FEMA is basically saying you have 30 days after your renewal to pay your premium. If you do not, we are going to consider that a lapsed policy, and when you come back, so if you have mandatory purchase, and when you come back after that lapse, you go straight to full risk. There is no glide path. So definitely encourage folks when they're selling or their policies renewing or something like that, do not drop your flood insurance because, again, you're going to go straight to full risk if you come back and buy insurance later. Before we get to the Q&A, I do want to share a couple other resources. So FEMA has a whole website out there for Risk Rating 2.0. It's been out there for a while. You can take a look and kind of get some generic information that you can share with folks. They also have created state profiles for every state and territory that they oversee. So I think it's like 56. It's 50 states, DC, and then the 5 territories. They have a state profile for each one of those. So you can go to that link and look at Kentucky's state profile and get some of the same information I've provided to you. The ones I'm really excited about, though, is on that state profile page, you can actually go down and look at the estimated discounts for your county, or I should say the estimated change for your county. So you can go on there and look and say, okay, I'm expecting this many to see this much dollar increase. I'm expecting this many to see no change, and this many to increase more than $10 or $20 a month. You can also drill down to the zip code level with those. So there's spreadsheets available. Go take a look. Definitely encourage you to play around and kind of see what's getting ready to happen in your community. Um, FEMA has also posted some interactive maps that ASFPM has created. So you can look at policies for single family policies or all of NFIP policies in your county and see, again, what kind of change are you expecting. So 40% are going to see a decrease, 53% are going to see a 0 to 10 increase, blah, 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 blah. So you can look at that at the county level. On those interactive maps, you can even tell that you only are interested in Kentucky and look at that. And again, compare your county to some of the surrounding ones. Last thing I'm going to leave you guys with before we do the Q&A, guys, is don't panic. I say this every time, guys. Ask me the questions. I'm here to be your technical expert. And if I don't have the answer, I'm going to go run it up the chain until we find an answer. So we're going to find out that answer together if I don't already know it. So we've already got a couple of those that I got to run up the chain to some of the Region 4 folks. But reach out to me, as always. If you have questions, email me. Happy to answer them. If you call me, I will call you back at some point, but email is best. Or you can reach out to the General Division of Water general contact, so water@ky.gov, or you can call the general line. And with that, we've got about 8 minutes left, so I am going to attempt to unmute everybody. So bear with me here. If you're not already muted, go ahead and mute yourself unless you want to ask me a question. But I'm going to let you guys turn your mic and cameras back on. So you guys should have the option now to unmute yourselves if you're not already. So if you guys have questions, feel free to unmute and ask them. Like I said, we've got 7 or 8 minutes here, so let's use that. Bombard me with questions. Fire away.